Hi, welcome back. Okay, we will look on levy of GST. That is the second chapter, and we will see various points on that. Levy of tax. Article 246A of the Indian Constitution empowers central and state government to levy GST. That we have seen already in the first chapter, with the photo of Arun Jaitley and other MPs looking at the board, displaying the total vote count. So the taxable event under GST is supply. Taxable person supplying goods or services, he is liable to pay GST. Yeah, Vimal, I will send the study materials surely. Sorry for getting delayed because of providing study materials. Okay, so the taxable event under GST is supply, because at the present scenario, the indirect tax are computed on various points such as manufacture, sale, service, etc. Because central excise duty was charged on manufacture, VAT or CST was calculated at the point of sale, and service tax was calculated at the time of provision of service. So all such points are removed. Manufacture, sale, service, all such terms are removed. Now the levy of tax under GST, and that is a taxable event, will be named as supply, and taxable person supplying goods or services will be liable to pay GST. Let us see dual GST again. I have already explained. Means for intrastate within the same state, CGST and SGST will be applied, and for interstate, that is from one state to another state, IGST will be applied, and IGST will be shared by the central government with the state government where the consumer is located. Liability to pay GST. The liability on recipient, that is called as reverse charge mechanism, that is I already explained. That is for imports and for notified supplies, reverse charge mechanism will be applied. On such case, recipient or the buyer will be liable to tax. So normally the seller has to pay GST, the taxable person supplying goods or services has to pay GST, but in such scenario where under reverse charge mechanism this liability is on recipient, the buyer has to pay GST, and in some cases the liability to pay is on the third person. The liability is on the third person, like there are separate provisions for TDS and TCS. It is not income tax TDS, it is in GST Act, and it is applicable on government department for TDS and e-commerce operator for TCS. That is also we are covering in the same beginner course. So normally the taxable person supplying goods or services has a liability to pay GST, but in such scenario where in the reverse charge mechanism or TDS or TCS, the buyer or the government department or e-commerce operators has to pay GST. Then notified transaction. Central government or state government, on the recommendation of the GST Council, we have already seen who is the GST Council. So central government or state government can notify the transactions which are liable to GST. The transactions exempted either generally or subject to conditions also can be specified. So the central government or state government on the recommendation of the GST Council can notify which transactions are subject to GST as well as which transactions are exempted from GST. That is notification. Then purchase from unregistered dealers. Who is an unregistered dealer? Unregistered dealer means the dealers who have not registered under the GST system, under the GST Act, who is not registered. You may be knowing that for registration we have to apply through the GST common portal, we have to submit various documents, we have to sign with the digital signature or e-signature, like that. All such formalities are there, and we will get a GST registration number also, and we have the power to collect tax and pay such tax to the government. So unregistered dealers will not get such powers, and the receiver of goods will not be able to get ITC because he is not paying any tax. Okay, so he is the buyer, who is the person who is receiving goods or services from unregistered dealers, cannot claim ITC, input tax credit, ITC It's the short form of input tax credit. Then the recipients who are registered under the composition schemes will be liable to pay tax under reverse charge. Here also reverse charge mechanism is coming. Okay. So when a composition scheme dealer is buying from an unregistered dealer, he is liable to pay tax under reverse charge. And supplies without consideration. Say in some transactions, even if there is no consideration or no money payment, still it will be liable to GST law. Suppose there are some transactions which are specified in Schedule 1. So when we are getting goods or services and when we are not paying any amount, we are not transferring any consideration, we have to check Schedule 1. There are some transactions listed under Schedule 1 of the GST Act, and we have to check whether these transactions are covered, and if it is covered under Schedule 1, we are liable to pay GST. And we will take one example. I went for in a hotel for having food. I had no money, and I gave my gold watch. Sorry, I don't have any gold watch, but for example, I am putting like that. Gold watch I am giving to the supplier. How to treat that? In this scenario, I am giving watch to the restaurant owner. In that scenario, the food giving by the restaurant will be considered as a supply, and he is liable to pay GST to the government. But I am giving my watch to the restaurant. Is it a business transaction? I am giving to the watch. I am giving my watch to the restaurant owner, not giving cash. But it is not in the course or furtherance of business, so it will not be called as a supply, and I am not liable to pay GST because I am paying it as a consideration. That is a case study. Then exempted supply. When exemption from all tax collected on goods or services has been granted unconditionally. When exemption from all of tax collected on goods or services has been granted unconditionally, can taxable person can collect pay tax because some goods are exempted. No, in such scenario we cannot collect tax and can pay to the government. So that is the first thing. Little tough. Okay, we will move to the second PPT, composition scheme. Okay, so under composition scheme, we already have seen what is composition scheme. If the turnover is below 50 lakhs, we have to pay a specific tax rate, and the main point is he issue a tax invoice. Okay, so that is composition scheme. The threshold limits is 50 lakhs. Already we have seen all such points. Then when one person is opting for composition, it will be applied to all business verticals or registration which are held by that person under the same PAN. Say one person is having a supermarket and textile manufacturing unit. Both are different businesses. That is called different verticals. Supermarket and textile manufacturing unit. There is no connection. So if that person has opted composition scheme for supermarket, in such case he has to opt for composition scheme for textile manufacturing unit also. He cannot say I opted composition scheme for only for supermarket. No, it is applicable to all verticals. Then he should not affect interstate supply, and he is not eligible to claim input tax credit. And the customer who buys goods from the composition, customer cannot opt for input tax credit. So these are the some important points regarding the composition. Then penal consequences. If a taxable person violates the condition and is not eligible for payment tax under the composition scheme, he is liable to pay tax, interest, everything, penalty, everything is liable to pay. Because, suppose say one person had a turnover of 55 lakhs. The composition scheme limit is 50 lakhs. But this person is having a turnover of 55 lakhs and he has opted for composition scheme without declaring his turnover. But later if it is found, he will be liable to pay everything. So that is regarding composition scheme. Thank you. And let us take the last PPT for the day and the last PPT for the second chapter. Remission of tax or duty. What do you mean by remission? Remission of duty or tax. It is relieving the taxpayer from the obligation to pay tax. Government is telling no tax is needed because there was a loss or destroyed due to any natural causes. The goods were damaged, the goods were lost, the goods were destroyed. And that is why the government is telling the person, no, the government doesn't want any goods. You are suffering a loss. So that is called remission of duty or tax. Then, remission is allowed only for those cases where supply of goods is found to be deficient in quantity due to natural causes. You understood? Only when it is happening because of natural causes and it is deficient in quantity, we can get remission. And there are further conditions because the people should not misutilize such remission facility. Then, what will be the situation if goods destroyed before supply? Remission of tax will apply only when tax is payable as per law. When tax liability will come? After supply, applicable upon on supply of goods only. So the taxable person will be liable to pay tax only on supply, and if it is the destroyal or loss is before supply, he is not liable to pay tax and remission is not available. You got the point? If the goods are destroyed or lost before supply, there is no remission of tax. There is no liability of tax. Okay, thank you. So today we are concluding the webinar here. I will show the study material again. Means for the chapters we covered. Okay, we covered the first two chapters, chapter 1 and 2. And there was a PPT video is there in the learning management system. That is overview of goods and services, overview of GST introduction. Then what is GST? What are the taxes that is subsumed? Okay, and intrastate, liability of the taxpayers. All such chapters are there. Okay, I have already seen showed that, so there is no need to repeat. So I invite your comments. What about the webinar today? Is it fine? Did you find it good? You can put your suggestions or you can put your criticisms also. I will improve next time if there is any shortfalls. Yeah, thank you all. Thank you for your good wishes. May God bless you.